Hi, my name's Michael Corcelli. I'm the founder and chairman of Flya. Today, we are at the Four Seasons in Brickell. I'm joined by the founder, CEO of Dream America, a very, very, very successful fund, a very, very successful gentleman here, a friend, my buddy Chris. Chris, take a moment, just introduce yourself, but don't give us the typical corporate spiel. Tell us who you are.
Okay. So thanks for that nice introduction, Michael. As Michael said, my name is Chris Ennis. I'm the founder and CEO of Dream America. I started the company after spending 25 years on Wall Street. Who I am, I'm a father of three, and with the help of Michael here, I'm in a rigorous workout routine each morning.
I love it. This guy's a savage. Every morning, 8 o'clock, downstairs at the Four Seasons, we work out. We do a little bit of cardio, a little bit of weights, and a lot of healthy eating. And both of us are trying to get in shape.
Yeah.
All right?
The healthy eating, more or less, but yeah, work in progress.
It's a really good environment. If you're in town or you're coming into town and you want to join us one of these mornings in one of our workouts, send us an email, call us, text us. You have our contact information. But first, before we begin, I want to thank you for your time and attention. And I want to tell you that I hope you get something out of this. This isn't a sales pitch. We're not trying to sell you anything. I'm trying to help you to get to know Chris and learn from his background, learn from his experience. He spent a lot of time on Wall Street, representing some money center banks in a very, very high level position. And he has a ton of experience and knowledge. And I want to get some of that out today and get him to share it with you. So as we begin, Chris, what is the most important thing you learned from Wall Street?
Oh boy, learned a lot of things from Wall Street. The most important thing I learned from Wall Street, if it sounds too good to be true, it probably is. We've all seen that a number of times. People are seeing it again right now with FTX, right? Sounds like something's great, surefire way to make money, and a career to work with a wide variety of hedge funds, institutions, corporations, private banking clients in a lot of different market environments over the years, and came back again and again to real estate, which is ultimately what led me to start Dream America. Although my time on Wall Street was really spent in the securities business and equities and derivatives, I've been a passionate investor and developer of residential and commercial real estate on the side. And that's ultimately what led me to what I'm doing today.
How many years?
How many years?
Investing in real estate.
I started investing in real estate in 2000. Although I would say my time in the single-family rental industry, which we're a part of, a niche within, really started as a kid. My parents kept the first house they ever owned, and when they moved to a second house, they started renting that out. This was the cleanup crew was right here. So whenever there was a turnover in the property, that was my first exposure to it. And then when I started on Wall Street, started making some money, I started investing in real estate.
So you and I have a very similar background.
You're also cleaning up houses when you were a kid?
My first job was for my grandfather sweeping the floor of a tax lien foreclosure that he picked up.
Huh.
And the floor I was sweeping was basically, it was like a 10-unit apartment building, and the floor I was sweeping was the bakery on the first level.
Right.
And I guess I did a good job because I got promoted to higher and higher level jobs, and he let me use some of the dangerous equipment. he probably would have been arrested and put in jail these days for child labor laws. But that's interesting. I never knew that. I want them to learn how what you picked up along the way over the last 30 years of your career, how they can learn from that for themselves and take something from that. So I guess what I'm trying to get at and trying to ask you is, you were given a big job at a young age.
Mm-hmm.
You had no experience to take that role on, as you said.
Yep, that's true.
What did your boss see in you to give you a team of 200 people,
Yeah.
$500 million, $500 million in revenue, and a lot of like a lot of assets that you were responsible for? A lot of things can go wrong, and you're representing the bank.
Mm-hmm.
You're putting the bank's balance sheet on the line every time you do a deal. So what did your boss see in you?
Yeah.
What do you think he saw in you?
Yeah, it's a good question. You know what? If you asked me at the time, I probably took it for granted at the time. So, but I think early on in my career, I mentioned before, like the importance of attention to detail. I developed a reputation as being really just kind of on point on details. Obviously, on Wall Street, like you said, there's a lot of things that could go wrong. There's a lot of unknown risks that are around the next corner. And so you spend a lot of time trying to think about those and plan for those. And despite all of that, things are still going to go wrong. So, one piece of advice that I always give to people, and we hired a lot of graduates over time, so I always talk to new people coming in, is establish a reputation from the beginning, no matter how mundane the task is that you're doing. And I think this applies to every industry, that you have great attention to detail. I always felt like derivatives was maybe a complex topic, but we could teach people that topic, but we couldn't teach them how to read or write. Like, they needed to do that by the time they came. We had people coming in from top schools all over, but then you'd look at a cover letter and there'd be typos in it. It's not acceptable. You got to be able to proofread your own work and spot check for whatever you're doing. And I think a lot of, people might say, kids today, what do they want to do? But I think this was true even when I was a kid, was everybody wanted to get onto the big job, and they didn't want to just do the grunt work that might not be exciting, but those details are really important. And the quicker that somebody could establish that they're able to do that, then somebody wanted to give them more responsibility. So that was one. Another one is just being a subject matter expert. I didn't know a lot, but the things that I knew well, so that even though I was very young, I could go and sit in front of CEOs or billionaires who are the bank's clients and speak very credibly on my topic. Obviously not on everything that the bank might do, but on my topic. So being that subject matter expert, whatever your field is also a way, to advance. And then I think what separated me from other people in sales wasn't that I was better at sales than anyone else, but I think I did a better job of handicapping winners versus losers. Meaning there's only so many hours in the day. So you can try to work more hours than everyone else, but there's still a boundary on how many hours you could work. And so I was always focused on, was the problem that the client had something that we could be helpful with? Like, would we be able to help? And is that something that would be profitable for me and the bank to spend time on? Or were we going to spend a lot of time and it might be helpful to them, but it wasn't going to be helpful to the bank? And obviously it's got to be beneficial for all parties involved. And I think that was something that I figured out early in my career and that helped me advance. So, and just organize how I spent my time. So as I went from being that individual producer focused on, could I solve Michael's problem, to how does my team solve problems for a client set and do that in an efficient way? Because as I said, even though it was a big bank, we still had limited resources. You've got whatever it is, 4 people, 6 people, 10 people on a team. They can only go to so many clients at a time. They can only work on so many projects. So as the manager, how can you help them be the most efficient with their time? And if they run into a roadblock, whether that's a roadblock externally with the client. They're trying to win some business, convince. At this point, Bank of America is viewed as a pretty good institution. When I was there, it was viewed as crap. This was pre-Merrill Lynch. B of A was not a sterling institution. So when we're going in and trying to get business, and the client, of course, is talking to Goldman and Morgan Stanley, who are just viewed at a whole other level, you had to be smarter and faster and more helpful to the client to even have a shot to get the business. So you had to be scrappy and helping the team do that. And then when they ran into roadblocks internally, there's always going to be roadblocks when we work in a big institution, different areas not, understanding what you're doing or thinking you're competing with them or you're creating new risks for the bank. You have to be able to navigate all of those things. So again, it came back to that problem-solving skill set that I had. It was just, instead of, like I said, me solving it directly, could I help you solve it, whether it was outside or inside the institution?
All right. So what I heard was time management.
Yep.
All right. Being efficient. All right.
Yeah.
Needs-based solutions.
Mm-hmm.
Looking for the client's needs and focusing on, can I help? All right. I heard a little bit of, being able to handle the bureaucracy of being in a large institution.
Which is probably only worse today than it was when I was there.
Right.
that hasn't gotten better. It's only worse.
But it teaches you.
It teaches you a skill set, which is if I'm meeting with somebody who's in compliance, they have a series of concerns. How do I get them comfortable that we're not going to create a risk for the institution? They got a job to do. I have a job to do on the front office side, but how can you get them confident that you're not going to destroy the institution in the process? That's obviously important because there's a long history of where there's compliance lapses in financial institutions. It ends badly. So
I also heard that you spread around the risk.
Yes. Yeah.
Like never put all your eggs in one basket.
Yep. Risk management is key. Not getting overly concentrated. Again, that's another long history on Wall Street, is when people get too concentrated in a good trade, everybody's in the same good trade, it never ends well.
I also picked up that, you were basically not only thinking about the customer, but profitability for the bank.
That's right. Yeah.
So it's being able to be flexible and balanced.
Yeah.
I mean, I don't think people understand the training and skill sets that you pick up working for a large financial institution.
No, and there's a lot of different pieces to it. Again, you could define your role as narrow. There's a lot of roles within an institution, but like I said, I always viewed my role as, how could we help the client and help the bank? The bank's not a nonprofit institution. We have to make money. It's not bad to say I want to spend time on things that are going to be a good use of my company's resources, so then we'll continue to have a business. Or we got a lot of people running around working on things and not generating revenue, for the bank, then you're not going to have a business.
So being in Wall Street, representing a large firm, being involved in money, there's always events that happen that, create gains and losses. And give us an example of, something that happened and how you dealt with something that was unforeseen.
Yeah, I mean, there were always things that were unforeseen that were happening. Again, we were dealing in the world of equities. So the biggest risks that we had related to the market, and a lot of those risks would revolve around an event tied to a single company. And so you can hedge those risks based upon what a model tells you to do, but the model always makes assumptions that things move in an orderly manner, that there's liquidity, a whole series of things. And this is where the risk management comes in to try to mitigate those unexpected moves. And so, the approach that we would take to it, and this came back to, the client solution element, and this is an old story, but in the first, run up in the internet, it's in 2000, everybody was crazy about the internet. All these stocks went to the moon. There were a lot of people who made a lot of money on paper in a short period of time, and they wanted to borrow against their positions. And so the bank, as you'd expect, that's what banks do. They lend money. So, B of A, they're going around lending money to a lot of different people. And then we were coming in afterwards saying, hey, you should hedge some of that risk. Sometimes on our own. Sometimes when the bank would suddenly get nervous that they lent somebody too much money, whether that was a corporation or an individual, suddenly risk management starts, knocking on the banker's door like you're overextended on these institutions. What can you do? So a lot of what we were doing, a lot of the products we were offering, were risk reducing, for our counterparty, which means that risk's then transferred to us. And then the trick is that risk that you're going to keep on your book, you're able to lay off to other institutions. So that was an ongoing process day to day. And the good news was when the stock market melted down the first time, so obviously 2000 crescendo, and then, the next thing you know, it's '02 and everything's gone down a lot. That actually turned into a profitable event for us because we had planned ahead for that. So there were definitely individual losses in the book, but in aggregate, it was profitable overall. Because it wasn't just a one way bet. And that wasn't some great genius on my part, Michael. There were a lot of people involved in looking at this, on a continuous basis. But I was happy to see that, it worked out well for the institution.
So let's talk about Dream America.
Yeah.
What is the problem that Dream America is solving?
Yeah. So the problem that Dream America is solving is, we believe that homeownership is a great path for the average American to build wealth. If you look at somebody that's a lifetime renter, they probably retire with no financial assets. If you look at a homeowner, they have that home over time. The real power of a 30-year mortgage is it's forced savings. So even if your home isn't appreciating, you're chipping away at the balance a little bit each month, and hopefully you own this asset in the future when you want to retire. That's a game changer. So our starting premise was this is something that we want to help. And this is not a new idea. There's obviously huge mortgage programs in the U.S., which are unique to the U.S. when you look at it globally. FHA mortgages, VA mortgages for veterans, which make homeownership possible for many people who would never be able to get a 20% down payment together and do what we would think was a conventional purchase. However, for the millions of people that are benefiting from these programs, there's millions more that are renting that are kind of what I'd say hovering around the hoop, meaning they've got income, they've got cash, but they just can't meet all the requirements to get mortgage ready, but there's a path for them. And that path is what we're trying to get to. So the problem that we're solving for is looking for people who, with some assistance can get over the hump and become homeowners.
It's very simple and straightforward.
And it's huge. So we looked at a few years ago major metro areas nationwide in the U.S. and FHA and VA turn down volume. So this is all public information because these are government-backed programs. And then drilled into it and said, why were people turned down for a mortgage? Were they turned down because the house didn't appraise? Well, we couldn't fix that. But were they turned down because the borrower's credit score was too low? We could probably help with that. So you kind of get into these granular reasons, and looking at that, we recognized that there was an audience of 35 million people that are on a path, they want to buy a home, but they may need a helping hand to get over it. So it is a giant market opportunity. And on the other side, who's serving it is very limited. So this is a space where you can count the competitors on one hand. We're not talking about, hundreds or thousands the way you are in mortgages or credit cards or consumer loans or any other kind of financial product where there's lots and lots of competition. This is an area, and that was part of what made it was intriguing to me, where there wasn't a lot of competition. So we could, kind of dig in and offer something that was differentiated. And coming back to what I said before about being at B of A when it wasn't a blue chip firm, my whole mentality was you have to do something that's differentiated. If we're just going to do what everybody else is doing, it's not going to be successful. It has to be able to stand out.
All right. So with that, let's go through some quick questions, quick answers. So how long does it take you to find somebody who's going to rent and you get comfortable with buying that home for them?
Yes.
From start to finish.
So we have
usually.
people. So we have people applying every day, and when we started, that might be 20, 30 people a month, and we would manually go through those applications by hand. As we established a little bit of a reputation in the markets that we're in, and we start getting more and more volume, we needed to develop an automated underwriting system to handle the front end of that, so that we could create an approval funnel. It couldn't all be done manually. And we rolled that out at the end of 2019. So now we're getting, say, a couple thousand applications a month. It would take, you could keep throwing more and more people at it, but it wouldn't be efficient to try to do that. And so we created a process where somebody could apply and immediately get pre-approved and a potential budget, or declined based upon the information on their application. And if they're declined, it'll tell them why they were declined. And we felt like this is, obviously people want to get approved, but being declined and knowing why you were declined, there's some value to that. There's some takeaway that you could, potentially work on and come back and get a better answer in the future. So I'm giving you a long wind up here for what you wanted a quick answer. But so if you apply and you're pre-approved, and we use Plaid, which is a big fintech company to link banks to your back end. So if you Plaid verified, meaning we can immediately get your bank information because you consented and put in your credentials, then all we need to do is verify your income. And if you submit your pay stubs and tax returns, because we're going to look at the same documents as a lender, and if you did that the same day that you applied, you're going to get an answer in 1 to 2 business days.
Wow.
It's quick. But most people don't do that. They apply, they don't use Plaid, and then they have to manually submit bank statements, which is fine. But then that starts to create a process where they wait a few days, they get their bank statement, they send them in, that has to be processed by client service. And then this sort of document collection process begins. And that could go on for weeks before we get all the documents we need to get to underwriting. But when people actually come to us and give us everything, the process is very quick.
So, Chris, tell everybody what Plaid is, because I know what Plaid is. I don't think most people know what Plaid is.
Yeah, I mean, go to their website, plaid.com. So Plaid's a great company that has established links with, 10, 15,000 banks, and it will allow you, when you need to verify your banking information with somebody, to immediately link your account, so that rather than somebody emailing us 2 months of bank statements, we can immediately get 2 months of banking data. And that allows us to then fast track their application to income verification.
It also guarantees that the information he's receiving is accurate as well.
Exactly. I mean, we do get people who submit fraudulent documents. It's, they're usually bad frauds. I'm not going to go into the details because then maybe they'll figure out how to fix them. But we catch documents all the time where people have tried to doctor their bank statement and send it in. And given the way our program works, they're only fooling themselves. Like if you fool us that you have money in your account that you don't have, and we get a house under contract, you're never going to move into that house until we get the full deposit that you need. So you didn't really benefit by doing that, but we're still on the lookout for those documents. And you're right, with Plaid, you're immediately getting that from the financial institution, and it's a great product.
Do you know how much it costs you to acquire a customer and to underwrite and then fund the loan?
Yeah, this is a question that people always ask when you're thinking about scaling a business. We spend very little money on advertising. We will occasionally, do email campaigns or do some ads in Google search, but most of the inbound traffic to our website at this point is naturally occurring through things that we've put out historically or through realtors. So we've got a network that includes thousands of realtors in Florida, Georgia, and Texas, and they have a natural incentive to promote Dream America. Why is that? Well, a rental lead is a low-value lead for a realtor. A purchase lead is valuable. They can earn a 3% commission on a purchase, which is paid by the seller in a transaction. So if I'm a real estate agent and you come to me and you're like, I got to rent because I can't get a mortgage, well, I'd love to get you into Dream America because now I can get the same economics as if you could get a mortgage as that realtor. So this network of realtors is promoting Dream America to their clients, and we've really focused our efforts on trying to educate the realtors on, what is the benefit for their client, what's the benefit for them, and that's how we get most of it. So we've not spent a lot of time saying we got to spend $20 to get each customer in the door, because we don't.
So that's interesting. I really I didn't realize that it was such a low cost to acquire a new customer for you. But I think that your automation of your underwriting process definitely keeps your expenses down.
Yeah, it does. It does, because 60% of the people who apply are going to instantly be denied based on the information they put on their application. Which doesn't mean we don't like them. It just means they didn't meet the minimum income or cash required, or they had a recent bankruptcy, or all of these requirements are posted on our website. So those are off to the side. And then for the people who did, most of them, as I mentioned, don't plat verify. So their first step is they have to send in their bank statements. If they never send in their bank statements, we never spend any time on them. So it's inefficient. We don't call somebody like, hey, Mike, you applied and you didn't. They'll get an email reminder, they get a text reminder. These are all things that are happening, automated through our CRM. But the ball's in their court to take some initiative and put these documents in. And we really view what we're doing as a dry run for a mortgage. So, whenever a realtor says to us, why didn't you follow up and get this stuff from someone? I'm like, if they didn't take the initiative to give stuff to me, why would I think that they're going to take the initiative, once we show them what they need to do to get a mortgage, to follow up with the lender? The hardest thing for us to underwrite is motivation. The math behind what we do is pretty simple. That's not hard to figure out. The steps that somebody needs to take in order to get mortgage ready, they're pretty easy to map out. Somebody then following it takes discipline. You think of it like a financial weight loss program. You could give anybody, there's all sorts of weight loss programs, but they only work if you have the discipline to stick to it. It's the same thing with getting ready for a mortgage. We can give people those plans. They then need to have that motivation to follow through.
So I love the fact that you're using automation to keep your costs low and to improve the processing speed to underwrite and fund a loan.
Yeah.
That comes also from your Wall Street training, and it comes to time management and efficiency.
Yeah, it comes back to all of these things at the beginning, which is whenever I was on Wall Street and we got bogged down in a lot of manual processes, it got expensive and it was more prone to error.
All right, so talk to me about the portfolio. You said you like to diversify your risk.
Mm-hmm.
So what size homes are you buying for Dream America's portfolio?
Yeah, so this is a great question. So if you look at our website, it'll say we focus on homes that are between 150 to 400. Unfortunately, 150 homes, which were more prevalent in 2018, are very hard to find now. And on the other end of the extreme, the $400,000 house, most of our clients don't qualify for that. So we're typically getting a buyer that's 200 to 300,000 in the areas that we're operating in Florida, Georgia, and Texas. And we've purposely selected cities like Atlanta or Jacksonville or Dallas, where if you're earning a median income, you should be able to afford a median price home. So as much as we like Miami and we're based here in Miami, we don't operate in Miami because it's not true here. If you're earning a median income in Miami, you can't afford a median price home. Our product doesn't solve to where we've got the highest likelihood of being able to help the client succeed. And at the same time, we feel like these starter price homes, there is, from a risk management standpoint, we like it because you can buy these homes below what they would cost to replace.
So $200,000 to $300,000.
Right. Which, when you're in Miami and you hear that number, that sounds like a crazy, number. You'd think, well, that's not a great house, but $300,000, you get a great house in Atlanta.
So what's the median income of somebody who's qualifying for your program?
Yeah. So our minimum income is $4,000 a month, but unless you don't have any liabilities, it's hard to get much with that. We're going to look at an individual's debt to income, just as a lender ultimately is. We can talk more about that in a second. So our typical successful client, I would say, is making $6,000 to $8,000 a month maybe more, and there may be one or two people on the application. So we have a lot of single, people, a lot of single mothers that are in our program. So it might just be one income, but some of the applicants are two incomes. But then just as important as the income is what are their payments. So the biggest payment for most people after their housing payment is their car, and overspending on the car payment comes directly out of your housing budget. That's one of the biggest things that we see every day. The people who, go, they get approved for a car loan, they make the payments, but then when it's time to get a mortgage, they realize that's really eaten into their housing budget.
So the car is a red flag in the underwriting process.
Absolutely something that we're looking at is what is the car payment. So when we get that successful applicant and we have all their documents and it's now been distilled down, it's ready for underwriting, we're looking at what are their income, what's their payment obligations, what savings do they have, and then what home price budget can we. Again, it's the same process a lender is going to go through, but we have to make some additional haircuts, if you will, because we're dealing with someone who's not getting a mortgage today. So we have to make an assumption about what a rate's going to be in the future, and or is this individual's payment obligations going to change in the future. We tell everyone in our program, they sign a pledge that states a number of different things. One of them is that they're not going to apply for new credit without talking to us, because again, that may sink. We underwrite somebody today and then they go and get a new car tomorrow. That may sink their ability to buy the house that they're living in. So, and we work really hard to avoid that.
So do you consider like a market appreciation when you've decided to enter into a market, or
yes,
when you're making a purchase on behalf of a renter?
So absolutely. When we started, we were looking at markets, Florida, Georgia, and Texas. These are obviously the story after COVID is more and more people moving into these areas, but that was already happening. That's been happening for years. These are areas with, Florida and Texas have no state income tax. These are areas with, Georgia's pretty low, like maybe it's 4%. So lower income tax, affordable property tax, business-friendly environments. So you want to be in an area where there's a robust economy. Obviously, that's the cornerstone of the housing market. So we do look at that. Our program is not a bet on home price appreciation per se, but we don't want to be in areas that people are moving away from, because again, that's just going to be a potential additional roadblock for the client when they go to buy the house and they're having a hard time getting it to appraise because everybody's moving out of their area.
Yeah, I mean, I like that from a sustainability perspective as well.
Yeah,
I think it makes a lot of sense.
Yeah, and these are trends, like I said, that started before us, and they're going to continue for many years. This isn't, you've been down here in Florida,
absolutely,
watching it grow and grow and grow. That's ongoing.
I left an economy that's shrinking,
right,
and the real estate's underperforming, and I came here, and everything was very undervalued. It was very, very undervalued. The statement that you made, why you're not involved in Miami, that was not the case when I came here in 1994.
Right. It was affordable.
It was way better than affordable.
Yeah.
It was incredibly affordable. It was incredibly undervalued. And with regards to sustainability, you are doing programs for people in places where there's going to be more job growth.
Exactly. These are areas that are continuing to grow. The demand for home ownership, we think, continues. We're not, although we're proponents of home ownership, which is a natural alignment with realtors. Realtors are proponents of home ownership. We're never selling anybody on home ownership. The people who are coming to us, they've already decided, I want to be a homeowner, and I've tried renting and waiting on my own. And in the meantime, my friends have become homeowners, and I'm still trying. So really you might think what they're paying for with us is a house. What they're paying for with us is the help that's going to get them over the hump so they become a homeowner.
Do people look at you as a landlord?
Yeah,
your customers look at you as a landlord?
No, it's a great question. So technically, we're a landlord. We own the property, we collect rent. However, if you talk to our clients, they wouldn't describe themselves as renters. They would say, no, this is my house. Dream America is helping me buy it. And that is what we're doing. And so we really view ourselves, and we tell everyone up front, We don't want to be your landlord long term. We're bringing people in with a 1-year lease, but they can buy at any time. There's no penalty to cancel the lease early. We've had people buy in a couple of months. Great. And that just gives us room to bring somebody else into the program. So, no, most of our clients are not thinking of themselves as renters. That helps us with a lot of things. It helps us with maintenance. People are handling routine items themselves. There's a leak under the sink. They're dealing with it themselves with a home warranty, just as a new homeowner does. They're not calling us the way they would in a rental. And they're really maintaining the home in a way that they want to live in it, long term.
It's their house.
It's their house. That's how that is absolutely how they view it. And that helps us. Look, we'd love to see 100% of the people in the program succeed, but they don't. Everybody doesn't, for a variety of reasons. People lose jobs, have medical issues, things happen, and they get divorced, change in situations. And so even with the people that are not succeeding in our program, we're still trying to give them the best possible outcome and work with them on transitioning into something that they can't afford. So look, at the end of the day, we have a fiduciary responsibility to our investors. If people aren't paying rent, they will be evicted. We've had to do that a few times. It's not something that we enjoy. But more often than not, when people get into that situation, we're able to have a conversation with them and they voluntarily move out because, again, they're not viewing us as an adversarial landlord. They're viewing us as someone that was trying to help them. And we just, have a candid conversation with them. And, look, it didn't work out because of X, Y, or Z. You can come back to us in the future. But at this point, staying in the home and waiting to be evicted, you're not doing yourself any favors. And that's true. Once somebody has an eviction on their record, much harder to get a future rental. That's a standard landlord. We don't do a standard landlord background check, but that is a standard landlord background check is, do you have prior evictions? Do you have a criminal history? What's your credit score? That's what most landlords are doing. We're doing something that's much deeper. That's what a lender would do, which is, what are your income? What are your payments? We're looking at your credit score, but the number isn't really what's important to us. We go down to 500 FICO. What's important to us is if you've had late payments, are those in the past or those are the last couple of months? If they're recent, it's hard to us for handicap, hard for us to handicap if you're turning the corner. If this was, 6 months ago, then there's a better indication that you are turning the corner.
So, Chris, with social media these days,
yeah,
and a lot of the trends, especially when rent prices were going up at fast rates, and the price to own a home was going up at a fast pace. There was a movement in social media land where people hate landlords.
Correct.
Do you see that as a risk for Dream America?
I mean, look, it's always a risk, but again, the relationship that we're trying to form with our client is one of we're really acting as a financial advisor, and so they have the ability to call us at any time. We can do a soft check on their credit, see where they are in terms of their progress. We're not lenders, but we can make that introduction to a mortgage lender when they're ready. And we can also come up with an alternative plan. Like I said, if it turns out that the house they're in, they can't afford it anymore, to try to come up with an alternative rather than it turning into a bad thing. And we're trying to push everybody through as quickly as possible to get from that renting position to an ownership position. 80% of our clients go on to become homeowners. So we've had a high conversion rate, with people who've gone through the program.
And do you have any history of capital appreciation, people walking away, not being able to refinance you out, to buy you out, and you making some money off of that as well?
Yeah, but the market's been appreciating the past few years, so we can't always bet on that. So we've got a few choices when somebody decides that they're not going to buy. We can reoffer that property to another client, and we do. That's not always a fit. An important part of our program is that people are selecting the home that they want to own. So if I just say, hey, you could rent own this house, and like, yeah, it's not really the neighborhood I wanted, your motivation is going to be lower to follow through. So we do try to offer it to our own clients. We might sell the house. And that's certainly what we were doing earlier this year when houses were flying off the shelf. We can also turn the house into a traditional rental. So, excuse me, even though we're not going to be a long-term landlord, we can put a tenant in place, and then we can sell that property to an investor. We've done all three of those things. So those are all different ways. Our goal is, if we buy a house today, we start collecting rent today, and then at some point our client buys that home back from us, whether it's in as little as a few months or it takes them a couple of years. We center on a year, but not everybody gets there in a year. And if that happens, then we don't spend $1 on vacancy costs or leasing, and we don't spend any money on brokerage commission when we sell to our client, because it's a direct transaction between Dream America and the tenant. So we have a perfect alignment of interests with our client. The best outcome for them is the best outcome for our investors. It's not like, oh, hey, you failed, so now I get to grab your deposit and you lost out. It's not a good outcome for us. So we're not trying to benefit on people failing. We want to win when people win. And if they don't, then we're going to try to reposition that property or resell it. And like I said, obviously, we're a for-profit, for-purpose company, but we want to make money on those homes as well.
Have you done any sensitivity analysis on the portfolio and how it would perform under an adverse real estate market condition?
Yeah, so we're in a tougher market now. Clearly, it's not an 08, 09, scenario. Everybody knows that interest rates have a huge impact on real estate, and so it's well-known headline now. Rising rates mean that what people can afford is declined dramatically, and that directly impacts, of course, home prices. So home prices are declining. At the same time, when we look to buy a house today, we can get a much better deal, because it's not, the headline is about the individual's cost of a mortgage. I see less stories about the securitization market is not underwriting these deals. So the really big buyers, the guys that own 10,000, 50,000 or more houses, they're also sitting on the sidelines and not buying houses. So when we show up as a cash buyer, we can get a great deal today. Now that's for a smaller group of clients. We're not buying as many houses now as we were, earlier in the year. But I actually think it's a decent time to get a good value. And then, to your question on sensitivity and downward pressure, we're not spending a lot of time trying to predict where housing prices are going, because that's not really the core thesis. The way that we think about it is in terms of duration. Our duration has been just over a year, meaning if you look at all the sales across the portfolio, we held them for, on average, 410 days. Now, some might have been 500 days, some might have been 30 days, but when you look across that portfolio of sales, so that's a relatively low duration asset. And what we expect to happen in a tougher real estate environment is the duration extends, meaning it takes our tenant longer to buy, or they don't buy and we need to put somebody else into the home. And so that home that we planned on owning for a year, we wind up owning for 2 years or 3 years or for a longer period of time. But still, as a real estate investment goes, it's a relatively short horizon. So that's really what we see changing in a tougher market. The markets we're focused on and the home price points that we're focused on, there is natural rental demand for these properties. So even if we're unable to identify people for our program who want these homes, we can tap into that local renter pool and put them into the home. Even though that's not our primary goal, it is important in terms of what is the value of the asset.
So if interest rates keep rising, how does that affect the monthly payment that your borrowers have to make?
Yeah, no, that's a great question. So
Your monthly renters.
yeah, so we're fully transparent on our rents. There's a calculator on our website. You go on there, you put in home price, you put on you pick a state, because there's difference in property taxes between state, and then you put in if there's any HOA fee, and it'll tell you what the rent is. That's the exact same rent we charge.
So you've basically automated that process as well.
It's automated. We're not doing what a landlord typically would do, which is say, hey, Michael, this is a better neighborhood, so I charge a higher rent in this neighborhood.
So what did you structure? What did you structure to with the
Mortgage
calculator?
rates. We do it off of mortgage rates.
No. But what did you structure to for a percentage return to Dream America?
Yeah. So when we started, we were doing high eights, and that was because we looked at, back in 2018, where was the exit rate for our borrowers, which at the time was 5.5% to 6%. And we wanted.
Isn't this much better than the office, by the way?
Yeah. This is great out here. Do this all day long. So we want our rent to be more expensive than a fully loaded mortgage payment. And you need to understand that our clients are not 700 plus FICO borrowers, meaning they're not getting those great rates that you see advertised online. You're a marginal borrower, you're going to pay higher rates. So we have to look at what's realistic for our client.
Where's the 30-year at right now? Six?
Yeah, high sixes, but our clients may pay more than that because
what would a typical client pay if they were able to get a mortgage?
Yeah, they're going to be paying 7 to 7.5%.
Maybe even more. Maybe
yeah.
Like
So
10%?
we're assuming. So if we bring not that high right now. So today, we're going to be assuming a back end rate of 9%. Even when rates were really low, down at 3%, we weren't assuming 3. We were assuming 6. We didn't predict what was going to happen with rates this year, but we knew they weren't going to stay at that level. And what we don't want to do is put someone into a house and then find out they can't afford it because now, rates are higher. So we absolutely have to look at that. So that rent calculator on our website, it's standardized across neighborhoods, but it's tied to mortgages. So that cap rate, if you will, that we had in the high 8s, we've now moved it up a point to high 9s. Because what was happening is, as mortgages were coming up, suddenly the mortgage was more than the rent. That's a disincentive for somebody to buy. Now, I can't go back and change the people who are already, in the homes. We need to work with those folks and get them through. And there are ways, different strategies we can use on that. But new people coming in, we need to charge a higher rent because it's another incentive for them to buy. When they're ready for a mortgage and they go, oh, my payment's going to be $200 a month lower. There's no reason to drag your feet and keep renting from us. Which again, we don't want you to rent from us long term. But if you looked at it and the payment's higher, we're creating a disincentive to buy. So that's why our rents, we're not looking at what could I rent a house down the street for. We're looking at what's it going to cost you to buy this house, and we want a payment that's going to be higher than that. So you're like, yes, I have an incentive to stick to this plan because I'm already living in the house I want to live in, and I'm going to immediately cut my payment.
So how are you managing the risk between higher interest rates and like flat payments for Dream America?
Yeah, so I mean, higher interest rates have definitely eaten into our return. We have of our debt is fixed rate long term that we're able to lock in earlier this year, but obviously rates stay high as we turn over those houses. That's not true forever. And then a third of our debt is floating rate bank line, and that's gone up, a few hundred basis points, just as it has for everybody else on the mortgage side. And although our rents have gone up, they haven't gone up as much as that. So that's eating into the spread that we have there. And so we just get more selective on the front end in terms of what we're willing to pay for the homes. We're demanding a deeper discount from sellers in the market that we're in. I'll give you an example. If somebody were closing on a house for, at the end of this month, we looked at their financials. They wanted a $300,000 house. It's a family in Atlanta. Based upon their debt to income ratio and our assumptions on mortgages for the future, which I told you we're assuming higher rates, we could only approve them for $250,000. At first, they're discouraged. Oh, $250,000, we're not going to get what we want. I spoke to their realtor who we've worked with on other deals, and she just decided, okay, I'm going to go out and I'm going to look at 300 houses, and we'll just keep submitting $250,000. And if you might imagine what seller's reaction is to that. Most of those houses at 300, they've already cut the price. Some are new listings, but guy already started on the market. But eventually, you find somebody who says, I'll take it. And so we had a house that was House next door to the one we're buying for $250 closed a couple months ago for $330. So that guy's not happy. The next door neighbor probably isn't happy. How did that happen? An individual seller has equity in the home and they're able to make a decision, which is, I'm moving to another state. I can't afford two homes. I need to sell this home. This is the best deal on the table. These guys are coming in as a cash buyer. This brings certainty to me. Maybe they've already been through the washing machine a couple of times with someone with a mortgage contingency and the deal didn't close. And so they're ready to, take a lower price, and that gets a great deal for our client. What our client pays when they buy from us is directly tied to what we pay today. So the more we can knock sellers down today, the better deal our client gets in the future. That comes back to what I said earlier about, even though we're the buyer, I view us as an advocate for our client. We want to drive a hard bargain, on the front end. The seller might not be happy, but we're not representing the seller. We're trying to get the best deal possible for our client. And that's obviously a mitigant then on I can't guarantee that house doesn't still go lower, but we obviously feel much better about being able to extract that kind of a discount up front, which you won't do on every property, but we can be selective and then we feel good about that.
I like that as for the customer, because the customer has somebody who is looking out for their interests.
Yeah, we are. They don't always recognize that. I mean, one of the things that I've seen, I wasn't in.
Your interests are aligned.
Yeah, our interests are aligned, but we're also very protective of our client. And I'll give you an example that comes up. What I found in doing this the last 5 years is, unfortunately, realtors and closing attorneys are too quick to forfeit a customer's earnest money. What I mean by that is, you put down a deposit of a few $1,000s for a house, you have an inspection period, you have some contingencies, and maybe you miss a deadline, something happens, and now the seller gets to keep your deposit. That doesn't cost the realtor anything. It doesn't cost the closing attorney anything. It costs you as the buyer something. And I've seen too many situations where the realtors are like, yeah, sorry, Michael, you lost your money. We have never lost the earnest money. We've gotten into some fights with people over it, but we will fight to the death. And that's not Dream America's money. That's our client's money, because they're giving us a deposit that's going towards their purchase. And if we lose part of that deposit in the process of bidding on homes, that's a potential loss for them. So we're really strict on, our detail and staying on top of things. But like I said, we're also strict on not, if there's a situation and there's, some of them are obscure examples, so I'm not going to go into them. But if a situation comes up and there's a dispute and somebody thinks like, oh no, now the seller is going to get to keep that deposit, it's not going to happen with us.
So with regards to duration risk, you see the average duration of the portfolio is 400 days?
It has been, and it's, it'll probably, may extend now, like I said, because it's harder for people to purchase. Our current clients, it's harder for them. I mean, if you're renting from us right now and you want to buy, we may have modeled in a higher rate for you, but you may be spending what you're making each month. Said differently, inflation is obviously hurting a lot of people in America. That's our clients. That's our clients.
Has it started to get better already?
I haven't seen it yet. I'm not talking about what you see in the statistics. Obviously, the market folks are looking at the government statistics each day. I'm just looking at, is it hard for people to pay their rent on time each month? Are they building savings towards their goal of purchasing a home? Or they're finding that they're coming up short a couple $100 each month? And I just see a lot of our clients, or whatever's going into their account, it's going out, maybe then some. And so they're just having a hard time keeping up with their essentials. So
there is pressure on the consumer right now.
Absolutely. There absolutely is.
And you don't see inflation already moderating a little bit?
No, obviously we've seen fuel prices come down, which impacts a lot of our, clients who don't work from home, obviously impacts them driving around. But I haven't really seen it on food, which is a hard thing for people to avoid. And look, no matter how much the Fed raises rates, does that lower food prices? I don't know. I'm not an economist. I'm not making a prediction on that, but it's not it's not intuitive to me that higher rates are going to cause people to spend less at the grocery store, which is a huge impact on everybody's wallet.
So Brian Bailey, the Federal Reserve Bank of Atlanta commercial real estate expert, um, he said that that's one of the concerns that the Federal Reserve has is they're not having enough impact on like food prices.
It's a tough one. It's a tough
Right?
one. I don't know what the solution is for that, but like I said, it's something that we see. Just think about it this way: if you have revolving credit card balances, then rising rates absolutely are impacting you. But if you're somebody who doesn't, then what impact is rising rates having on you? It may not have any. Now, if it causes your company to lay people off and you get laid off, yes. But I'm saying what's having a bigger impact on most Americans day to day is inflation. And you see that, right, in the election. That's a comment that comes up a lot from people. What are they concerned about? They're concerned about inflation. Like, I'm paying more for everything. Yeah, I got a raise, but my raise is all going to my landlord and to other people. So I actually have less money in my pocket than I had before. And we're absolutely seeing that. And look, that is a risk to our business because we can't solve that, right? So we can look at things that we can. So maybe there's equity in the home, and we can help our client tap into that equity as part of the purchase to cover their closing costs. We've done that in a number of cases. So there may be things that we can do. Maybe they can use some of that equity that's built up in the home to buy down the rate. See a lot of the lenders now promoting like a 2-1 buy down, so you can get a lower payment for the first couple of years. So there may be things that we can do to help. But if inflation persists for a long period of time, it's a risk to us. It's a risk to a lot of different businesses, which is why the Fed is saying they're going to do, whatever it takes to bring it down. They have to.
So Chris, my son's taking an economics class. He's a senior in high school. He is number one for his returns on his portfolio. I asked him, "Hey, what's going on with school? How are you doing in school?" He says, "Well, Dad, I'm I have to make some moves in that portfolio because I lost some of the money, and I got somebody else in the class that's kind of like crawling their way up behind me, and I want to stay in first place. So, like, I want to get into Costco." So I said to him, I said, "Is Costco a consumer stock?" And he said, "Yes, it's a consumer stock." And then he started to give me all these bottom up, like fundamental reasons why he thinks that Costco is going to outperform even in this environment. Have you optimized Dream America to perform better in a
Yeah.
rising inflation environment, in a recessionary environment? Have you optimized the way you put out the money?
Right. No, it's a great question. I don't know if we've perfected it, but we're constantly tinkering with it. So what we can tinker with, and we constantly do, is underwriting requirements. We've gotten much tougher since the summer on what it takes to get into our program. Why is that? Is that we don't want people in the program? No, because we look at some of the people that joined the program this year that are currently struggling and going, well, that's not good. How do we avoid that again? So we're looking harder at what reserves do people have beyond the funds that they're using to join us. What is their income history, which we've always looked at, but also what is their industry? What is it that they're doing? So if you're a nurse, I'm less worried about your employment than if you have a commission sales job. One of the clients we have that's struggling right now is manager of a jewelry store, killing it the last few years, dying now. Nobody's buying jewelry. So that's one of the clients that's in the process of moving out. It's just not going to work out for her because she's had a huge loss of income. So we're trying to underwrite what are what's the likelihood of income continuity, which every lender again is trying to do, but we may be doing it tougher, and what are costs that people may have that a lender wouldn't think about. Like we had somebody who's a driver and they own their truck and an expensive truck. We were looking at like what's the year of the truck and what's the cost if this thing breaks, because we're looking down the path and going, this guy comes in and what event is going to derail him. We're not going to predict all of them, but that's one that derails people all the time. Car accident. You can't control that. We can't underwrite that. But that can be a huge bump in the road for our clients. Again, our clients, the average American, car gets wrecked, you're not able to work, you have a tough time paying your bills. We can't underwrite that. That's just a risk that exists in the portfolio. If you have more savings, though, you have a better cushion for an unexpected event, whether it's a car accident or job loss or whatever it is. So we've gotten tougher on our underwriting requirements and drilling down harder on, what is somebody's profession and what's the likelihood that's going to, be able to continue, and we'll see.
When you were on Wall Street,
yeah,
what was the subjects that you were a master of, or an expert?
So there was a product that was developed when I was at Salomon Brothers called the accelerated share repurchase. It's a product that companies use to buy back stock. I didn't invent it, but I was there when it was invented, and I was the first, one of the first salespeople to kind of grab this product and run with it, and I became an expert on this product, which then soon had me, at the time I was 25 years old, sitting in front of the CFO of major banks, commercial banks, who were clients of Salomon Brothers, which was the first industry group to adopt this product. By the time I went to Bank of America 4 years later, that product, the ASR, had spread across Wall Street. It's now been done by thousands of companies. It's still a common product to this day. And then we started focusing on collars, which was a risk management strategy for single stock positions. And again, that just happened to be
Is that for the billionaire clients?
The right place at the right time. Yeah, because in the first internet boom, there were a lot of people, individuals, but also companies, where they had strategic cross holdings in each other, and they'd sell their division and take back stock. And then they didn't want to sell the stock because they had low basis in it.
You dealt with banks, the CFO,
initially. Yeah.
The CFOs of regional banks, money center banks.
Exactly.
Right? You dealt with billionaires.
Yeah.
And now you're dealing with people with low credit scores.
Correct.
What is your passion? What is the passion for Dream America?
Yeah, look, I like solving problems, and we're trying to solve a big problem here, and I like helping people out. And the thing was, when I was younger and I was helping out all these big clients, they were going to be fine whether I helped them or not, Michael. They were already big companies, wealthy individuals. They didn't need my help. And the truth was, in order for us to help them, we were, like I said, clawing our way past these other banks that wanted to help them as well, because there were fees to be earned. Now I'm dealing with people that nobody wants to help. They're marginalized in the banking system. The things that we're telling them, banks could tell them this. They could give them this advice. We don't have any secret, but they by and large don't. And now we have people calling us every week saying, God bless you, you made a difference in my family's life. That never happened to me in 25 years on Wall Street. No client ever called and said I made a difference in their life for their family. They might have been happy with the trade, but it didn't change the course of their family's trajectory.
Unless it was a negative.
Oh yeah, no, then they would call and go, then you would get the call.
But the upside calls you never
the upside call, you didn't get that. So now, look, we get a lot of personal satisfaction in the investors who invest with us. Obviously, we want to earn a financial return. Like I said, we're for profit. But at the same time, we are helping people out. We're helping out people that don't have a lot of places to turn. And we enjoy that. It's fun.
So we are almost out of time. I have a couple more quick questions for you.
I'll try to give you shorter answers.
All right. So you went from helping CFOs, like banks, billionaires, become, wealthier.
Yeah.
Right? To now you're helping people that actually need your help.
Yeah.
but you haven't talked about what type of help you need. So how can the people listening today help you?
Yeah, look, I mean, it depends who's listening. If somebody's listening and they're a real estate agent, as I mentioned, we have a lot of realtors that work with us. They can go to our website, dreamamerica.com, take 10 minutes, read about the program, learn a little bit about it, and then register to work with us. So we have new agents signing up constantly. We're always looking to expand the network. As I said, that's how we keep our cost of bringing clients in low, is through this great network of agents that have partnered with us. And then if somebody's on the call today and what we're saying is resonating and from an investment standpoint, they'd like to learn more, then we'd love to talk to them, to accredited investors, family offices, people who could get behind our mission and want to earn a good return while helping folks out.
So what are you open to at this time, from a direct fund investment? What are you open to from if somebody wants to lend Dream America money? What are you open to from a co-investment opportunity with the right strategic investor?
Yeah, we're open for anything that makes sense. On the lending side, we've got a great group of partners already, so we're not really looking to add any additional lenders in. But we still talk to institutions from time to time. Never hurts to have a conversation because you don't know where it's going to go. In terms of, we have a fund structure, so we're an operating business, as you got from this. Individuals, accredited individuals, can invest in the fund, and we could also set up a separate account, for a family office or institution that wanted us to run the strategy for them in a dedicated fund.
So what I hope you got today is Chris is a very competent guy. He has a lot of experience. He has institutionally structured Dream America. It's an excellent investment opportunity. He's helping people, and he's playing inside of his own passions. He's playing with things that he started his life being involved with, like real estate. He's drawing upon his background in derivatives, his background from Wall Street to structure transactions. I hope you give him some help and put some money into his fund. Become an investor. Reach out and talk about a co-investment opportunity. And with that said, we're going to go to Edge at the Four Seasons and enjoy our happy hour. We hope you got something out of this. That was what the goal was. It wasn't to sell you any investment product. It was for you to get to know Chris and to learn something from his background. He's an exceptional guy. You can always reach out to me. I'll connect you with him. Or you can reach out to him directly by...
Shoot me an email, chris@dreamamerica.com. Go to our website and hit us up in the chat and say you're looking for me.
If you ever want to go to the pool at the Four Seasons, get a nice hotel room, and I think they're about $1,000 a night. Jeremy, do you mind showing a little bit of the backdrop over here and what we got before we end the live stream?
Yeah.
I'm actually going to get up and just give you a quick... Chris, you want to say bye?
Bye, everybody. Thanks for joining us today. Thanks, Mike.
I'm going to tell you why he moved, from New York to Florida. So, for those of you that are not here, come to visit us during our Basel. It's coming up December 1st through the 3rd. And come and visit. Have a great day.